Okay, very good morning everyone. Welcome to the briefing then for Monday the 26th of September. Hope you all had a great weekend. Just getting straight into it, and already this morning a bit of a risk-off sentiment seen thus far. DAX seeing a bit of an extension of the initial gap lower. We had a lower close on Wall Street on Friday. That sentiment generally continued overnight in the Asia Pac session. And so we gap lower through the 10,600 level in the DAX this morning, and then another run lower here, which was exacerbated by some light stops just being run on the break of 10,500 before just finding a bit of a respite here and some of that recent selling. Likewise then the S&P future following in sympathy and providing a bit of a catalyst then for risk off trade and the kind of more classic relationship then, a flight to quality into fixed income futures. So T-notes bid already this morning to test up at R2, a gain of 5 ticks now on the session. Not too much movement though in the dollar with these latest moves. The dollar index is broadly flat. We're only down around 0.07%, so just a slight move higher in euro dollar, but cable already down around 24 pips on the session. We're going to get into cable a bit more detail. Piers issued his latest kind of forecast for the pound going forward for the rest of 2016, 2017, so he's going to jump on the mic in the next few minutes as well to talk you through his reasoning. One of a fairly scary but familiar chart I've just seen come down on Twitter is this one. You're probably all familiar with it now. It's Deutsche Bank. So Deutsche Bank shares have slumped to a fresh record low. Continued capital concerns surrounding the bank. It seems to just be they've never really seemed to get over the hump of the market wanting to really force down their share price on the unknown or uncertainty surrounding their capital levels. Now you can see here the two lines you're looking at are the Deutsche Bank share price for one, which is now at record low levels, and then the orange line is the 5-year default probability. And you can see it's up at pretty much its most elevated levels that we had since the beginning of the year, which, if you remember rightly, this big move and sharp move higher came after the market saw the highest bout of arguably consistent volatility over a 2 or 3 week period when there was huge concerns about the health of China, and the banking stocks generally very sensitive to that type of news. So we're almost back to that kind of situation for Deutsche at the moment. The biggest thing though that the market has been talking about in recent weeks has been OPEC. This meeting in Algiers obviously gets off today and it runs through till Wednesday. Now this meeting does carry some headline risk, and what I mean by that is a snap comment hitting on the news wires that can often have the propensity to move crude oil markets very quickly and in a very violent fashion. Actually, if I just highlight this chart for you here, actually managed to finished the week off on a bit of a high note. I was here a bit later with Piers, and just before 5 o'clock on Friday late afternoon, a comment dropped. Saudi Arabia sees the upcoming meeting in Algiers as a consultation and does not expect any decisions to be made, according to sources citing an informed delegate. And actually we managed to get hold of a bulk of that last moment sell-off that was actually a pretty decent move in the end. I mean, we were around 45.50 when the headline hit. Technically as well, we broke that low print that was seen the European morning, and then there was a pretty sizable flush lower, well over $1 to finish off the kind of week. And that did also lead to the lower close on Wall Street on Friday. Looking where we trade at the moment, we are up slightly around 23 cents. But this is going to be one of the key ones to watch, I'd say, from the first 3 days of this week. Now, in terms of setting the scene, these are the types of, this graph kind of summarizes the situation. So this is the bearish oil bets in the market. So when people were most in short positions. And you can see when the Algiers talks was initially announced by OPEC, obviously people got very nervous about the fact that they might step in, start to coordinate. Whenever they all gather, the market tends to, on initial response, think that possibly this could be the time when action is taken to counter prices and provide some stability to the market. So then the shorts bail on that trade, but what you can see is that as of really that comment from Saudi Arabia, because they are the key component to having a compromise being struck. Now that they've downplayed this Algiers meeting, actually bearish bets have started to increase again in the futures market, in the speculative market. You can see though prices have been more relatively stable, but the underlying positioning of futures contracts does tend to give us a bit more of a bias in the way that the market is leaning, and the way that that's moved higher would certainly suggest that the markets have lessened their belief that potential action could be taken. So this is the kind of state of play as a headline summary. Saudi Arabia, of course the world's biggest oil exporters, offered to cut its output to January levels. This is of course that source comment which we saw caused a big bid in the market. I think that was on either Thursday or Friday morning. But now on Friday, Saudi Arabia signalled that Algiers meeting will be consultative and unlikely to reach a firm decision. So just be aware, in terms of my tweet deck and Twitter monitor, I've got it all set up. That hashtag, the one to use if you use a search filter, is OOTT. OOTT. It's like the organisation of official tweeters, basically. So they tweet everything oil related. And in my other search filter, I've got OPEC sources. Because as you well know, those who are more experienced, OPEC love to leak comments or slip a word or two to the press way ahead of actual scheduled meetings. These are one of the things to understand with the news in OPEC. They do not stick to predefined schedules or times like, say, a central bank official would. They will comment as and when they feel, when they want. So just look out for that. Just moving on quickly, one of the other things which is definitely going to be the headline story tomorrow is, as you know, or you should be aware of, is that at 2 a.m. London time tonight, we'll see the first televised debate between Clinton and Trump, again, which is expected to be watched by over 100 million people in the US. So it's the first one, and this is very important because stakes are high as the opinion poll leader after the first debate has won the election each time over the last 40 years. So if history is anything to go by, whoever comes out top in the opinion polls after tonight's first head-to-head battle would typically go on to get in the White House. And as you know, current state of play, Trump has been performing extremely strongly in the polls, and if anything, given the populist turn in view more generally, there's a high probability that he could come out on top. And so, from a history's point of view, this could get interesting very quickly. And on that note, I've seen this headline this morning. This is going to make one person, Will DeLucy, a extremely happy man, because Citi have put out a warning on gold as bank has boosted their odds of a Trump win now to 40%. So more and more people, I remember at the very beginning it was just a completely non-event. Trump was just a joke, but now you've got one of the world's biggest investment banks saying there's a 40% probability of winning the presidential election, and investors will be preparing for the possibility of higher US interest rates in terms of what Citigroup are saying, but in terms of the risk, the political risk is certainly increasing, and that's talking about the US only. You've only got to go over to Europe when you look at the likes of Italy and Renzi's commitment in a Cameron-esque style to his future pinned on a referendum and reforms. Then you've got the populist right-wing rising of Le Pen in France, coupled with a fragile situation for Rajoy in Spain, trying to form, at this point, a piece-together government. There's a lot of concerns on a political global prospect, and that's irrespective of Brexit negotiation talks. Actually, just looking at gold here, you can see the price really from 2016. I mean, certainly we got the biggest boost when China saw that real volatility. Then you had the oil price in February was tracking down sub $30. That obviously was going to have a read across into generalized lower inflation, therefore lower interest rate and monetary policies. Gold remained bid. The various action that we've had from central banks, but we have leveled off more recently, but certainly we are sitting only around kind of $15 from the highs seen year to date, so not too far. And looking at gold since the European morning, you can see on my chart here, we've gone from around 37 back up to pivot at 41 since we've had this bit of a sell-off in the equity markets this morning. Again, it's really hard to bet against gold really when the fragility of this equity market in this political environment, and then with Brexit negotiations still yet to be kind of concluded on that side of things. I'm going to have a quick look at the calendar. I'm going to kind of swerve talking about the pound for the moment because as you saw in the email shot I did this morning, Piers has put out his latest call and he's going to talk you through that in the next couple of minutes. So just quickly moving on to the calendar for today. Economic data-wise, you've got the IFO business expectations. They're coming out at 9 o'clock, so 15 minutes. And this is actually one of the biggest pieces of economic data we get out of Germany on a monthly basis, so this is an important figure. And just given the setup of the markets this morning, with stock futures on the back foot already, just keep an eye on this figure. It does have the ability to be able to force these prices further lower if we get a substantial miss on expectations. So that's at 9 o'clock. Looking at the chart here, you can see the previous number that we came in at 106.2. That was well below market expectations last time we had this reading, which was of 108.5. It was the lowest reading since February. So any number that we get here, which continues this trend, does have some worrying implications because German data specifically, as we saw in the PMIs on Friday and other data of late, factory orders, industrial production, German data has been on the weaker side. And IFO is important because IFO is forward-looking. And when you've had headlines and likes of the front cover of the FT this morning talking about a hard Brexit, what is this going to mean for companies and analysts for their 6-month outlook going forward? And that ultimately is how the market will start to reprice on those expectations. So the IFO number will be very important this morning. Back to the calendar this afternoon, new home sales, as I've mentioned a couple of times, US data really, I guess, taking a bit of a back seat now given the next more interesting and viable chance for the Fed to move rates is not until December. But check out the speaker schedule. It is very busy this morning. You've got Curran has already spoken. For any of you who caught up what I put in the chat room this morning, Curran, the boy who cried wolf really is Curran at this point, said the central bank stood ready to use every possible policy tool to achieve its 2% inflation target. What does the yen do? The yen strengthens. So, it's kind of diminishing effects of the power of his verbal intervention at this point. The yen, I'll quickly bring it into shot for you, more of a byproduct of just flight to quality type moves with the equity sell-off that we've just seen from this morning. So since we've come in, really the cash equity open, that flush lower in equities, the yen has seen some strength just come into the marketplace. Going back to the other speakers, ECB's Mersch 9:15, you got Curran, Fed's Kashkari, ECB's Draghi. Appears a committee on economic and monetary affairs, so maybe that would be quite a key one as well to look out for later on this afternoon at 3 o'clock. Okay, going to hand you over to Piers now. he's going to jump on, give you a bit of a summary of his outlook. The blog that he wrote, I sent out to your inboxes earlier this morning, but I'll hand you over to Piers. Thank you, guys.
Thanks, Anne. Just before I talk about the pound, my favourite stat of the morning, on the theme of the US election. So since World War II, this was in Deutsche Bank's read, so if you've already read this, you'll know this stat. But since World War II, there's been 14 recessions, and 9 of them have taken place in the first year of a presidential term. So obviously 2017 is a first year of a presidential term, and odds on recession time. Although just picking up on what Ant was talking about, Citigroup obviously raising their expectation of a Trump win to 40%, which obviously sounds very high. It is still obviously therefore less likely that Trump wins. Let's not forget that, but obviously tonight is massive, to say the very, very least. You could even go as far as to say tonight's debate decides the election. But what Citigroup was saying with gold is actually if Trump wins, then you could well get a real hawkish development with regards to Fed policy. Trump's made no secret of his disgust over what Yellen and her team are doing, and so you might get a hawkish spin, even though the government are supposed to be independent of the central bank. You could get a hawkish development, which isn't good news for gold. So if Trump wins, it's not necessarily buy gold, even though that's the kind of natural knee-jerk thought. If he does end up being hawkish, then that might backfire. I'm just watching these equity markets continue to slide here. Just seen the DAX edge another new low, and S&P also. So, really picking up from where we left off, I would say, on Friday's session. Just definitely a negative vibe, I would say. But we're a long way off. If you looked at the daily chart for the S&P, there's plenty of room to move lower without us getting outside of any kind of major ranges. I mean, you've only got to go back 2 weeks and the S&P was testing 2100. So all we're really doing here, Friday really gave back Thursday's gains, and now we're just trying to give back some of the Wednesday gains as well. Obviously, this boost to the upside was off the Wednesday, you might say, dovish central bank actions. But anyway, I'm just going to talk about cable. You'll have read the blog, I'm sure. So just to really talk about what's going on here. So we posted this little note on Friday, and actually it's quite good. In terms of what supports this sort of idea and theme is the front page of the FT this morning, which is talking about, if I just switch across my screenshot, one of the lead articles on the FT this morning, City of London fears May government is shifting towards a hard Brexit. This is particularly led by Liam Fox and Davies, who are the Brexiteers that were handed key positions in the cabinet. So David Davis is the Brexit minister, and you've got Liam Fox as international trade secretary. So these guys were placed in these roles because ultimately, Theresa May pretty much said, look, okay, you're Brexiteers, you've won the vote, now get on and sort out an exit. Which seemed like quite an interesting idea when it happened. I think as time's going on, it might be that it backfires a little bit, but we'll see. Certainly the City are very scared of Liam Fox. And they're very scared of his, what seemingly is a pretty blind, one-dimensional view of the Brexit situation. He's blind to the fact that all he can see is the political factors that are at play. He seemingly doesn't really care about the economic side. So he's definitely keen on a hard Brexit. Now, there's a rumour he's going to make a speech tomorrow in front of the World Trade Organization. This is potentially a pretty big moment. We'll see. But the rumours are he's going to make a speech. And the rumours are that he's going to basically declare that we're going to be a member of the World Trade Organization, and that therefore we're going to be, once leaving the EU, we're going to be ready to begin negotiating on new treaties, new economic and trade treaties with the rest of the world. This could be Liam Fox putting down his marker, and the chances of a hard Brexit, that would be the scenario which would be most damaging to the UK economy in the short term. The chances of that might well go up. So look, with the pound and with the UK economy, we've obviously had quite a balmy summer in that panic off the back of the vote on the 23rd of June has subsided, and we've had some really strong economic data. The figures, we've been talking about this a lot. The manufacturing and the services sector PMI numbers rebounded very sharply. You had a really strong retail sales figure. Things like industrial production, strength, real positive. And most of it, I think it's easy to be complacent and assume that, well, all this scaremongering from the Remain camp about how Brexit would kill our economy, well, obviously that was just scaremongering, and it looks like this Brexit scenario is not going to have any lasting negative effect at all. That would be the complacent view. There's one reason mainly driving the surprisingly positive economic summer, and that's the chart that I'm going to show you now. Sorry, hang on, I was showing you it already, I think. Here we go. So it's the daily chart of sterling versus the dollar. And, it's collapsed, obviously, 35-year low. And we've been tracking, and the important thing about this is, even though we've been getting good economic data from the UK, this thing's been going sideways. Now, what's important, and what I talked about in the blog post, was the fact that over the last few weeks, we saw a pop higher at the start of September to hit the top of the range. Anything up around 135 is such a massive price point for this currency pair. We drove up to there, and that's because the UK manufacturing and services PMI numbers were off the scale. What's happened since then is that this thing's drifted all the way back, and we're now sat down around the bottom of the range. And this is despite the fact we've had continued good data from the UK. We've actually had bad data from the US, and the Fed have not been able to hike. Fundamentals would point towards this market being at least up at the top end of the range, if not breaking higher. Except that what the fundamentals say is not what the market is doing. So the market's been trending lower for 3 weeks, and the key price, we made a 6-week low on Friday. Key price to keep your eye on this week will be 128.72, the mid-August low, and then the 128 handle, which is the post-Brexit low and the 35-year low set start of July. Okay, if this exchange rate can't go up when we've had key positive fundamentals for it, well, then it isn't going to go up. And therefore, I think there's quite a key risk of this currency pair breaking these Brexit lows. I think that also, just thinking economically, this has been a real boost for the UK economy, but it's probably going to be a temporary one. What we got to keep an eye on in the coming months is inflation in the UK, because obviously the pound dropping sharply does lead to import prices jumping sharply, which should in time feed through in a positive way to inflation. And if you start getting inflation pushing higher, then obviously this turns into a negative from an economic point of view. Things cost more. We can't afford to buy as much. So it may be, and then when you get the Brexiteers like Liam Fox, beginning to ramp up the hard Brexit risk, well, then you could get a bit of a double whammy as we go into year end. We could get the scenario where the chances of a hard Brexit increase, plus inflation comes through a lot stronger, and this like honeymoon period of a cheap pound, quickly vanish. So keep an eye on this, but certainly for this week, I think the two big prices in any market really is 128.72 August low, 128.06 Brexit low. Okay, keep your eyes peeled. Any downside, and the thing just to finish with, let me go to like a monthly chart. The thing is about these prices, if I just get the credit crunch sell-off. German IFO coming. Sorry guys, I'm actually going to get off the mic here. 10 seconds to German IFO. All right, these are actually strong numbers. Well, certainly on the headline, 109.5. The reason why that's particularly strong, if I post my screenshot here of the chart, that's a new high for the year. That's a 12-month high at least. Let me just go back. That's the highest we've been.
The headline, that's revised high to 106.3 from.
Yeah, that's the highest reading. You've got to really go back at least 2 years. It's a 2-year high for German IFO. And this German IFO, this is important
Just to go
data.
back over the Italian data as well.
Just keep your eye on the euro here. So you got a euro just pushing off the back of this number, and just look for the high of the day, which was Friday's high, 112.80, anywhere around 112.80's key resistance, and then above that you got the high point of last week up at just shy, 112.98, so just shy of that 113 handle. So a little bit of euro strength. You did get the DAX pop higher. I mean, it was already. Well, yeah, we popped higher. We've given that back, but we may well see the DAX, which has been under a lot of pressure this morning. Deutsche leading the drop. But this is pretty strong numbers and goes some way to kind of offsetting. We had a bit of weakness on the German PMI numbers last week. But this is definitely an important measure. A good lead indicator for economic conditions in Germany. It's like measuring the entrepreneur's sentiment. So it's really measuring activity levels and confidence levels from those people really operating right at the coal face of the German economy. So this is an important number. So this might just calm the nerves. We'd had a pretty weak start to the session. It felt a little bit negative and a follow-on from Friday's negative sentiment, but this might be enough just to steady the ship here.